right, we are live on YouTube, so yeah, I don't disagree with you. Good morning, everybody. We're pulling up everything here so we can get started. It's Friday. We're gonna learn something today. I assure you, we're gonna learn something today. Um, uh, good morning, good morning. Ronald Jones, can you just please give us the news real quick before we get started on anything else?
Yeah. So we only had 8:30 news. We had two red folders, core PPI and a PPI folder.
Okay, cool. All right, ladies and gentlemen, we're nearing the top edge of this bullish outside bar on this quarterly. I'm sitting here telling you, if it breaks this high, we're probably going to go to the highs. Uh, but that's just something to keep you got to keep your eye on it and watch it, right? So that's that. Monthly, same thing. If we break December's high, it's going to go probably go up. But right now we're still in a wait and see mode, because if you didn't get any of this move up, what you don't want to try to do is be getting up here, because you don't know if it's going to break through or if it's going to. So it's best to do some short term stuff right now, or be on the sidelines and kind of wait for the market to tell you from a long term perspective. Just my opinion. This is not financial advice. I'm just telling you what I see. Right. Um, from a weekly standpoint, I don't know why I got all that over there. Okay, there we go. Again, it's an uptrend. So this is, it should go into it might, I ain't gonna say it should. It might break these highs because it bounced off of this support area. If you go back and look at some of my videos, I talked about how it got down here in the support area, and then the support area held. So going long would have been the lick. And then on our daily, what we see is real simple. It's going back up here into this resistance. You just don't know, right? But some charts say it should go up, some charts should say it will go down. However, we don't know that for sure, and we only trade when we have a confluence of the markets. What that means is the markets are pretty much saying the same thing, and we catch pauses on smaller time frames, right? Um, that's how we trade. So, from a long-term perspective, there's nothing to do right now. I've recommended everybody that's part of my group that, hey, be on the sidelines, be nimble if you want to be in anything. So again, this is not financial advice. This is just how I see the markets based on my experience over the 25 years of looking at these things. Uh, and I look at numbers more than I look at anything, but that's another story. If you want to know more about that, just hit me up at support@theprofitstalker.com. But please subscribe and share, because, man, we give information that you're just not going to find in too many places other than talking to professional guys who are professional traders and do this for a living. Uh, anyway, so that being said, let's get to our intraday stuff. We are going to have class today, and what we'll do is we'll get off, and then we'll get back on a little bit later on today. We won't go long today. We're gonna go to about 12, and then we're gonna have class at about 12. Quentin, do you mind sharing the link out with everybody? And also,
Okay.
what we're going to do is, so let's just look and see what these markets are doing here, because this thing went up mighty nice, mighty nice. All right, all right. Now we just wait on everything to line up. Quentin, can you queue up anything? If you can't, just let me know and then I queue it up on my side.
Give me about 5 minutes and I will.
Okay. Mhm. Yeah, this is interesting, everybody. This is interesting. Looks like this thing is trying to catch some legs to the upside, uh, even from this morning. So we literally just gotta wait on. Just gotta wait on her. Mhm.
Any preferences? You want to finish the book we started yesterday, maybe?
Yeah. Yeah, it's too late now.
I'm just making sure.
Yeah.
All right, just let me know when they're ready.
Go ahead.
Success with cotton. I was unable to benefit from the bull market in silver in 2011, but I succeeded with another speculation, which corresponded better to my skeptical nature. Hence the following story. A friend of mine, who lived in Berlin at that time, had a small textile company, with its production site in a small town in the federal state of Brandenburg, in the east of Germany. This fact alone amazed me, because in 2010, there were not many textile companies that were able to produce in any of the former East German states with their high unemployment figures. Rather, one would have expected the production sites to be in countries like Bangladesh. My friend's company made industrial textiles, mostly workwear for hospitals. It was a niche in which she managed to assert herself over the years, with the help of a loyal team. I really admired her for this achievement, engaging people in that weak economic environment by making clothes. Hats off. We met for a cup of coffee.
Too late.
And I remember that we also talked about
too late.
time to
It
time.
dropped so hard.
At the end of 2010,
Hard.
she called me, asking if I had time to talk. She knew that I was involved in the stock market. She sounded restless on the phone. When I met her a day later, she looked very worried. At first, I thought that her company had run out of clients and that she would have to dismiss employees. That had happened in the past. It turned out, however, that her concern was quite different. I have several sales orders, she said, but I cannot deliver. Why? I asked. Normally you always deliver punctually. Yes, she said. That's not the problem. I cannot get any cotton. We're desperately waiting for a delivery, but it's just not coming. So we cannot produce. No cotton, I said. How can that be? Cotton is as plentiful as sand on the beach. I thought it was. She put on her worried face again, and then she began to inform me about what was going on in the cotton market. Apparently, there was a big shortage of cotton. Apparently, when she started to explain the situation to me, I got a little lesson in the world of raw materials. All around the world, cotton is harvested during different seasons. Then it is produced and transported to the spinning mills. In that year, there was a weak harvest in the important production country, Pakistan. Demand had grown steadily in the previous years, especially China, with its hot economy, was hungry for all kinds of commodities, including cotton. In addition, there were export restrictions. And as if that was not enough, producers in Pakistan and India began to hoard their supplies due to steadily rising prices. They simply are not handing over the cotton anymore, my friend said in a desperate tone. They would rather fill their warehouses in the hope that prices will rise even further. The situation is desperate. In fact, the price of cotton on the Intercontinental Exchange in New York had risen by more than 160% in 1 year. At the time when my friend made me aware of the problem, the price of a pound of cotton stood at USD 1.68. When I looked at the chart at home, her problem became clear to me. In the preceding years, the price had fluctuated between USD 0.40 and USD 0.8 per pound. There was no problem getting cotton at that time. Actually, there was always enough cotton, but the exceptional demand from China and the weak harvest had fueled the price. It was an extraordinary situation. When the producers began to hoard, there seemed to be no cotton available. This was, of course, an artificially induced shortage, but it brought small textile companies, like that of my friend, to the brink of insolvency. For a speculator, such information is worth its weight in gold. I could read the seriousness of the situation and the utter exaggeration in the price in my friend's eyes. Her desperation actually told me everything. She had orders in her books. Heck, the customer was waiting for his workwear, but she could not produce, let alone deliver, because she could not get cotton anywhere, although the warehouses of the producers in India and Pakistan were over full. This information was served to me on a tray. See Image 12, Cotton, 2005 through 2019, monthly chart. I had never dealt with the cotton market before. As I began to study the cotton futures chart in the final weeks of 2010, I realized that I had come to the party too late. It had already built a parabolic slope. To enter the last phase of a bull market did not seem advisable to me.
You got the sell market button
Since
up.
I was pretty much bearish at the time anyway, I decided to keep watching the
Phone's not
futures on
muted.
cotton and eventually go
Okay.
short. In January 2011, the price of cotton finally rose above USD 2, attaining a high of USD 2.29 in February. I watched the future every day to see signs of weakness. When I realized that a price above USD 2 was not sustainable, I went short with a first position, just under USD 2. The position immediately went into profit and was never in danger. Encouraged by this confirmation, I opened further short positions, which also went into the plus relatively fast. The volatility was extreme, and the PL, profit to loss, on my platform changed to my favor or disfavor faster than you could imagine. Not for the faint-hearted. Unsurprisingly, due to the twisted mood, the first bearish news for cotton came in. Instead of the expected demand of 120 million tons for 2011, expectations were revised downwards. Only 113 million tons were expected. Demand began to slow down. First and foremost, from China. As if that was not enough, the first reports of very good harvests came in. India expected an increase in production of 255,000 tons. Similar news came from West Africa, Turkey, and Greece. Of course, that was news that did not really give the cotton price wings, so to speak. On the contrary, although there was a technical correction in April, I remained short and even expanded my position. My assumption that the upward movement of 2010 would be completely corrected was confirmed. In June, the price finally reached the USD1 level. The price had thus more than halved. I gradually began buying back contracts to close my position. Once again, it was an incredible ride, but I managed to make a decent profit with the cotton crash. I had never been able to trade such a downtrend and came away feeling quite satisfied, though my enthusiasm was somewhat subdued by my previous bad investments in the stock market. I called my friend and asked her how things were going. Everything was fine, she said. Cotton was readily available again, and her company was able to produce and deliver on time. Although my short cotton position is unlikely to have had much influence on the price, I modestly helped to push the price down. This corrected the bubble, which was ultimately the result of an artificial shortage. This time, the real evil speculators were certainly not the short sellers, but clearly the greedy producers, who hoarded more and more cotton due to the rising prices, thereby fueling the price even further. The cotton crisis of 2010, 2011 was really
There's an
lifelong.
echo somewhere.
Of course.
What was that?
I said there was an echo somewhere.
You cannot consider her report as insider information about a particular market. She was far too helpless herself at the moment. But the story taught me that such crises may well contain valuable information, especially emotionally vivid information, that may offer the opportunity for successful speculation. It pays to go through the world with your eyes and ears open. Chapter 12. My Ruble Trade. It is well known to every trader that the price of oil is an important factor on the world stage. It is therefore essential that you keep an eye on it, as well as on other important indicators, such as the dollar or the yield curve of US government bonds. Whenever capital is withdrawn somewhere and flows to another place, it is often because something important is happening in one of those indicators. See image 13, oil price, monthly chart, 2003 through 2019. Between 2007 and 2008, the oil price was in a spectacular bull market. An excellent chance to make a fortune, by the way. After rising to over USD 140 a barrel, the price plunged below USD 40 a barrel after the financial crisis. It was an unprecedented crash that took just 6 months. Again, an excellent opportunity to make a fortune with short positions. Between 2009 and 2014, the oil price recovered and reached a price of USD 100 again. Then all became quiet. Oil seemed to stabilize at that level. Technically speaking, it formed an extended symmetrical triangle. If you ask me, this is not a very reliable technical pattern. There were smaller breakout attempts to the upside, all of which failed. I was already lurking in the shadows because I assumed that oil would eventually break out to attack the highs of 2008. However, this did not happen, and the price continued to go sideways at around the USD 100 level in the first 2 quarters of 2014. And as so often happens on the stock exchange, when the expectation of market actors, including myself, is not fulfilled, the opposite happens. Oil broke out of this sideways pattern on the downside in the summer of 2008.
Hold on 1 second, ladies and gentlemen. Had a little glitch there.
14. The crash was not as spectacular as in 2008, but still a slide from USD 100 to USD 27 is spectacular. That's a loss of value, of 73%. I have to admit that I was completely surprised by this crash. Once again, I had been deceived by my expectations. The price of oil just had to rise because the world needed more oil and the supply was becoming scarcer, I thought. I could just watch the oil price going down day by day. That is what you have to deal with when you have certain expectations. And then the opposite happens. You can only stand on the sideline and watch. But it got even worse. I did not get in, not even with a small test position, because I assumed it was a false breakout. I expected the market players to suddenly take a 180-degree turn. In the end, this did not happen. It was a real breakout, and the price of oil continued to fall. Of course, the analysts were soon on the spot with their explanations. There was more oil than everybody thought. How interesting. As if this oil had not existed in 2011 and 2013, when oil was stable at above USD 100 a barrel. The second explanation also seemed obvious. This time, the Americans, more specifically, the shale oil boom, had caused the price to collapse. In just a few years, the US had become the largest oil producer in the world, relieving itself of its independence on Saudi Arabia. All this seemed to catch the market players' attention in July of 2014, although they couldn't have cared less about what the Americans were doing in May and June. You see, the analysts always have their explanatory models ready, but they do not take them out of the drawer until the market begins to confirm their assumptions. That autumn of 2014, I pondered as to how I could still benefit from this movement. The opportunity came, but from a very different side than I expected. I should have known, but it did not dawn on me until the first news broke, that the Russian ruble was in trouble. What does the ruble have to do with oil? Pretty much. 2/3 of Russia's exports are oil and natural gas, and the gas price is mostly geared to the price of oil. Half of the Russian taxes come from these sources. There are also some other countries that are heavily dependent on oil prices. Canada, for example. And indeed, the Canadian dollar also slipped in the fall of 2014 against most other currencies, most notably the dollar. A long position in the US dollar/Canadian dollar seemed a logical consequence. Long US dollar, short Canadian dollar. But for some reason, I was more interested in the Russian ruble. It was a currency I had not traded before. It does not belong to what you can call the usual trading instruments. Basically, because the spread on the spot markets is far too high. The ruble had indeed depreciated against the dollar in September and October. See image 14, US dollar/Russian ruble, daily chart, September through December, 2014. The US dollar/Russian ruble pair rose from 35 to 42 to 43 in September through October, 2014. In the case of the US dollar-Russian ruble exchange rate, rising prices meant that the US dollar was appreciating and the ruble was depreciating. There had been an upward trend, but there was still no sign of an emerging buying frenzy, selling frenzy for the ruble. However, this changed in early November as volatility increased significantly and the US dollar/Russian ruble suddenly rose to 48. I bought a first test position at the end of October at 43 and felt that my assumption that the ruble could continue to depreciate had been confirmed. Of course, there were reasons for the crash of the ruble. The West imposed economic sanctions on Russia. Wake of the Ukraine crisis, Crimea, which were now beginning to take effect. Well, the 2014 ruble crisis was not the first. During the last ruble crisis in 1998, it was already all about oil. And this time, the further crash of the oil price in the last quarter of 2014 seemed to accelerate the fall of the ruble. The Russian oligarchs withdrew their money from the Russian accounts and placed it in dollars, Swiss francs, or euros. When the smart money gets out, it accelerates the depreciation of the currency. During the course of November, I started to expand my position. Although the ruble mostly went sideways, I even had some losses. as the US dollar/Russian ruble fell back to 45 in late November. I was thinking about reducing my position when the US dollar/Russian ruble started to rise towards the 50 mark in the last few days of November. I started buying again. Meanwhile, the price of oil had fallen below USD 70 and was heading towards the USD 60 mark. For the first 2 weeks of December, the USD/Russian ruble continued to rise, reaching 55, which prompted me to further expand my short position in the ruble. I now had serious profits. Finally, on the 12th of December, the 55 level was conquered, and the USD/Russian ruble appeared to be heading towards 60 in the third week of December. 60 rubles to a dollar. In Russia, queues formed in front of the exchange offices because everyone wanted to get rid of their rubles. People began to spend their money and bought electronic devices, cars, and non-perishable foods. A scenario set in, similar to the situation in 1998, when the Russians lost confidence in their own currency. Of course, the Russian central bank stepped in. The central banks are always the most important players in the matter. On December 11th, they raised the key interest rate from 9.5 to 10.5%. The central bankers stepped in, although as recently as October, they had raised the key interest rate by 150 points due to an expected rise in inflation rates. Contrary to their expectations, this measure could not stop the fall of the ruble. The market had obviously expected a larger move in the interest rate. The ruble fell further. Although there were rumors that the central bank had intervened in the foreign exchange market several times, but that did not stop the downward move of the ruble. After the weekend, the decline of the ruble continued. The US dollar/ruble rose to 64. The rate hike of the previous Thursday had no effect. I kept buying and waiting. On Monday night, President Putin finally intervened, forcing the central bank to raise the key rate from 10.5 to 17%. That was a huge increase in the interest rate. It was the same measure that had been taken in 1999 to stem the ruble crisis of the time. On the Tuesday after Putin's intervention, the volatility was insane. The US dollar/ruble was swinging between 60 and 78 within minutes. I was thousands richer or poorer. It was clear that the market had been waiting for Putin to intervene. Only nobody knew how the ruble would react. I watched with fascination as the US dollar/ruble rose to 78. Therefore, I had huge gains with my position. However, during the day, the pair fell sharply, and it dawned on me that we might be experiencing the final act of the drama. I've learned by now that if the chart goes parabolic and the volatility gets insane, it's usually a sign that we may have seen the highs. I started selling, admittedly, not at the best prices. Everyone, of course, wants to sell at the high, although it must be clear that this is impossible. No one knows where the high of this move will be ultimately. I began to systematically scale out my position. After all, I had made considerable profits. I sensed that Putin's radical intervention might be a turning point. The ruble had already devalued vastly, and the possibility of economic sanctions from the West and the crash of the oil price were factored in. I kept part of the position in case even this drastic measure did not work. This assessment proved to be wrong. Although the US dollar/ruble rose above 70 again on Wednesday, it was unable to hold that level on Thursday and Friday, so I closed the position completely. At this point, let me say that some readers may regard this kind of speculation as morally reprehensible. You can see it either way. You can either consider a speculation against the ruble as a reprehensible act to the detriment of the Russian people, or you can consider the devaluation of the ruble as a necessary correction of the market in order to force the Russian leadership to take measures to regain control of the rampant inflation. After all, such a dependency on crude oil is not a healthy basis for a stable economy in Russia in the longer term. The market is forcing Russia to reconsider this position. For one thing is clear: as long as this dependency exists, any fall in the price of oil will put the ruble under pressure. The devaluation of the ruble was necessary for the Russian economy, Just as the decline in the cotton price ultimately had a positive effect on the textile industry, it was to the detriment of greedy producers who would have been happy to see even higher cotton prices. You can argue any way you like. As a speculator, it is not your job to save the Russian economy. There are always two sides to trading and speculating, buyers and sellers. And as long as you consider it morally reprehensible that there must be a seller in every transaction, you have not understood why the stock market is even necessary. Sometimes you stand on this side, and sometimes on the other side. If you want to make money, your job is to be on the right side more than you are on the wrong side. That is all. Chapter 13. Thanks to Presidents Erdogan and Trump. In 2017, I already had an eye on the Turkish lira. The inflation rate in Turkey had risen to 13%. That's high, but not unusual for an emerging economy, as Turkey is. The lira began to depreciate in 2017, but all of this took place within a reasonable range. See image 15, Euro/Turkish lira, February through September 2018. From March 2018, the lira began to depreciate a bit more, and in April 2018, when it jumped over the 5 lira per euro mark, I went long with a first position in the Euro-Turkish lira currency pair. With the Euro-Turkish lira currency pair, rising prices mean that the euro appreciates and the Turkish lira devalues. I had to be patient. The lira hovered around the 5,000 mark for the remainder of the month, and even dipped below that mark towards the end of the month, putting my position a little bit in the red. Since the loss remained manageable, I kept the position. In May, the devaluation of the lira accelerated. As soon as the level of the 5 lira per euro had been reconquered, I bought a second position. I was rewarded for my courage, because soon the pair climbed in the direction of 5,500, which gave me several thousand euros in profits. The causes for the devaluation were varied as always. Probably the most important thing to me were the rising interest rates in the USA. In the months before, this had led to significant outflows of capital from the so-called emerging markets to the United States. This was especially the case for countries like South Africa, Argentina, Brazil, and Turkey. As the Fed began raising interest rates, I realized that this would lead to a general devaluation of the currencies that had hitherto lived off of the US low interest rate policy. Above all, the Turkish economy profited from these capital inflows. The current account deficit of Turkey was, and is, especially large. In short, that means that the upswing of the Turkish economy in the years before was largely built on credit. Another accelerator was the refusal of the Turkish central bank to raise interest rates, which is the usual monetary policy instrument to fight inflation and the devaluation of its own currency. This refusal was not voluntary, but rather due to pressure from President Erdogan. Normally, the central bank should act independently of the policy. It is not to be assumed that any politician who happens to become president also understands monetary policy. In the case of Turkey, the central bank was considered independent. That fell away, de facto, after Erdogan's election victory. Erdogan publicly stated that interest rates that were not determined by him were the father and the mother of all evil. As the reader might know, interest-based banking is banned in Islam. As the devaluation of the lira accelerated further in May of 2018, the central bank was only able to prevent a further decline by raising its base rate by 300 basis points, from 13.5% to 16.5%. Although this led to a temporary recovery of the lira, the currency continued to trade above 5 lira per euro level. On the days after the jump in the interest rate, my position suffered, but it was never really in danger. Of course, I expected an intervention by the Turkish central bank, despite Erdogan's rhetoric. A clear increase in interest rates was a signal to the markets, and to me. However, the lira did not recover significantly. It did not even recover when Erdogan announced that he wanted to bring the presidential and parliamentary elections forward to June of 2018. On June 7th, the Turkish central bank announced that it would raise rates again by 125 basis points. Although this led to some gains for the lira, It did not impress the market in any way. On June 14th, Erdogan tightened his rhetoric against the financial markets by threatening to act against the rating agency, Moody's, after the election. This, of course, was a ridiculous statement of no importance, to which the lira responded with another devaluation of a good 1,000 pips. When Erdogan's AKP finally won the elections, and Erdogan had a clear majority in parliament, the lira did not recover either. On the contrary, when he boldly announced that interest rates would soon be falling in Turkey, the devaluation of the lira began to accelerate all the more. Although the euro/Turkish lira continued to move sideways in June and early July, it was stable above 5,500 from mid-July, which encouraged me to buy more positions. Somehow I knew I was on the right path. It was becoming clearer and clearer that it was Erdogan himself who was going to talk his own currency into the ground. I could not have chose a better ally than the Turkish president for my speculation against the lira. And it continued. On July 9th, he appointed his own son-in-law as minister of the new finance ministry. Erdogan empowered himself, through a presidential decree, to appoint the governor of the central bank. By doing so, he definitively abrogated the independence of the central bank, although it was
Guys,
all...
there's a bad echo on the, I don't know who it is. Wait a minute, hold on. Something just changed. Do you know, does anybody know what changed?
No, I just paused it. That's all I did was pause the audio.
Okay, so pause it for a second. Let me see here. All right, play it again. Let me see if
aware that some people in Ankara were really starting to panic. The more Erdogan seized the course of the monetary policy, the sooner he undermined the meager remaining stability of his currency. On July 24th, the Turkish Central Bank announced that despite a renewed rise in inflation, it would leave interest rates at 17.75%. This led to a renewed sell-off in the lira, as well as on the Turkish stock market. Everything went according to plan for me, although a real catalyst was still missing in order to catapult the euro/Turkish lira really up.
How was that?
it's perfect now. I think it was on my side, actually.
Oh, okay, no issue.
I sensed that it would come. I just did not know from which corner, and I could not have guessed that it would be President Trump who would really get my speculation against the lira going. More specifically, it was not Trump himself, but an American pastor of the Evangelical Presbyterian Church named Andrew Brunson, who would eventually bring me a sizable profit. Brunson moved to Turkey in 1993 and founded a small Church of the Resurrection in Izmir. When he wanted to renew his visa in 2016, he was arrested. He was accused of espionage and support for the banned PKK in Turkey. In 2017, the US demanded the release of the pastor. Erdogan's offer was an exchange. He would release Brunson if the US surrendered Fethullah Gulen to Turkey. Gulen lived in exile in the US and was believed by the Turkish to be responsible for the coup attempt of July 15, 2016. The tug of war between the two countries surrounding the American pastor created a tense relationship between the two countries, which eventually led to a veritable diplomatic conflict. On August 9th, Erdogan delivered a speech proclaiming, "If they have their dollars, we have our people, our righteousness, and our God." Hereby, he squandered any hope of economic reform and a monetary policy that did justice to the facts. The reaction of the market was clear. The lira depreciated again, and the euro/Turkish lira rose to 6.15. Looking at the chart, which had gone parabolic in the last few hours and catapulted the gains of my position into the six-figure range, I sensed that the end was near. No one knows in advance where the high will be, just as nobody can predict the low. When the euro/Turkish lira finally shot up like a rocket on August 10th, rising to an incredible 7.83, I started scaling out of my position in the late hours of August 10th, unaware that we were actually seeing the highs in euro/Turkish lira for that moment.
Like, come on, where you
Of
see
course,
What it was.
sell at that high again. I was able to get rid of some
Okay, what you said?
So I'm trying to see if this thing's gonna turn around here. So that's my apologies. I didn't realize I wasn't on mute. So I'll go back on mute. Go ahead.
contracts at a fantastic price of 7.5. Others at a slightly lower price. It was a fabulous profit. Although the euro/Turkish lira rose over 8 the next day, I could only watch it doing so. I was completely out. When euro/Turkish lira fell back below 6.5 in the days after, I was quite satisfied. Perhaps I should have sent thank you cards to the presidents Erdogan and Trump, because it was their play acting that enabled this huge gain for me. Chapter 14. Speculating with stocks. An important question that arises now is whether this method works just as well with stocks. The answer is clear. Yes. There are plenty of examples of traders who have become rich by buying a particular stock and systematically expanding their position as the price of the stock developed in their favor. You do not need to get in at the start of the movement. Of course, each of us would like to have bought Apple in 1998 and then held on until 2019. The likelihood that you will succeed doing it like this is infinitely small. Besides, the question here is not how to become wealthy slowly, but how to grow a small account fast. You can do this if you trade Apple, Amazon, or Facebook for a few months. I would even say that this is an excellent method. So, do not look for some obscure Kazakhstan stock to do it with. Stick to the current market leaders, because then you will be trading with the big funds that do exactly the same thing as you. The likelihood of a trend turning here is much smaller, unless the market's players' perception of a company were to change abruptly, which usually does not happen quickly with companies that have a good business model. See image 16. Amazon. Weekly chart. August 2017 through September 2018. If, for example, at the end of April 2018, after the minor correction, you entered Amazon at a price of USD 1,500 and held out until September, when Amazon finally reached USD 2,000, arrow on the chart. That USD 500 price gain would have been enough to make you a fortune. In addition, you had 4 months to gradually expand your position and trade with the market's money. To better visualize the big market leaders' trends, I like to use the Heikin Ashi chart, especially the weekly chart. As you can see from the example of the Amazon stock, there was hardly any technical correction during this movement from USD 1,500 to USD 2,000. This is typical of stocks that have a large following. Therefore, you should trade exactly these stocks if you want to implement the strategy that I propose in this book. This is where the best chances for success are. On the chart, you can see how the big funds trade stock. Every minimum loss day is an invitation to buy the stock. On a weekly basis, you hardly notice it. The Heikin Ashi charts help you stay in the stock, even if it goes in the other direction for a few days. See image 17. Apple, weekly chart, July 2016 to November 2017. This weekly chart from Apple shows clearly why you should trade the market leaders. The liquidity in these stocks is so big that the chance for random reversals or corrections is very small. If the market players involved in such a phase come up with the idea of selling the stock suddenly, it will be due to clearly bad news from the company or a negative outlook for the next few quarters. That's why it makes sense to trade such a stock from the reporting season to the next reporting season. In between, there are sometimes excellent trend phases that can take several months. As a speculator, you can benefit from these trend phases, so you do not have to buy the stock and hang on to it for years. If you prefer stocks rather than general markets, then you should trade stocks. Of course, you should be aware that stocks are the securities of a company, and companies are run by people who can withhold information from market players. I do not claim that such a scenario cannot happen in the general markets too. The difference is, if you trade an index like the DAX, the CAC 40, the Dow Jones, or the Bovespa, you have no management risk, as you have when trading a single stock. You always have a market risk, and I do not deny that an event such as the flash crash of 2012 could not happen again. That is why I say that you have to write off the money for each specific speculation in advance. However, it seems to me that the risks involved in trading general markets, such as stock indices, commodities, or currencies, are lower than when trading in individual stocks. There is another reason why I prefer to trade markets rather than stocks. Even though they may have strong trends, if you trade the Alphabets, Apples, and Amazons of this world, because they are going up, you are basically doing trend following. You follow the trend in the hope that it will continue for a while. Now, trend following is a legitimate way to earn money on the stock market, but it is usually a slow method. There's nothing wrong with that either. But as we want to grow our small account fast, we are violating the fast rule with trend following. You will have noticed this from the examples of trades that I have carried out. For speculation, I usually choose a market in which some kind of crisis is going on. I favor situations in which something comes to a head. The reason is simple. Such markets are prone to exaggerations, and if I'm well positioned, I usually benefit disproportionately from such situations. That was the case with silver, financial crisis 2008. That was the case with the ruble crisis and the lira crisis. In all such crises, what happens is that the market overreacts. It's usually noticeable that the chart starts to rocket or build a parabolic rise, or starts to fall in the case of a downtrend. And when a chart assumes parabolic shapes, I know that the end is near. Then the time has to come to realize the profits. However, the specific main factor of my method is that the vast majority of profits are realized in the last, and often dramatic, days of the crisis. Why? Because in the weeks and months leading up to it, I have built up my position step by step, and I am fully invested in the moment when the exaggeration really starts and the market overreacts. At that moment, I want to have my biggest position. Of course, if you simply follow the trend, you can also make good profits, but often not as much as you could achieve in the kind of crises I'm talking about here. That's why I favor crisis markets, because they promise me the biggest possible profit. That leads me to perhaps the most important reason why I prefer this method when it comes to growing my account fast. This method is designed for people who have a winning mentality and who know how to make the most of the extraordinary opportunities that the stock market offers now and then. This is an attitude that is more about maximizing profits than avoiding loss and risk. If you go to the stock exchange with a mindset of not wanting to lose, you will lose. But if you go with the absolute will to win, then you have good chances of winning. Is it really that simple? Yes, it is. Chapter 15. Trade what you see. As a speculator, you should try to be honest, at least to yourself. If I report some success here, it does not mean that I should not admit my mistakes as well. I have been wrong more often than I have been right. For example, I mentioned that I tried to short the DAX and Dow Jones several times between 2010 and 2012, even though we were clearly in a bull market. Actually, I knew it too well. Looking at the long-term chart, it showed me that the long sideways phase of the years 2000 through 2009 in the Dow Jones was over. And I had a good argument too. If the Fed lowers interest rates to zero, you can barely make any money with bonds. What does a manager of a large fund do in this case? Exactly. He increases his equity quota, because in equities, he can at least earn a return on the dividends. I knew it, and I even publicly proclaimed it at a podium discussion for investors in Brussels. Each speaker was asked to make a forecast for a market. I showed the audience a long-term chart of the Dow Jones on a big screen, and I showed them an upward price projection. Based on my analysis at this conference in 2010, I prophesied a Dow Jones of 20,000 points. The Dow Jones stood at about 10,000 points in 2010. One half of the audience looked at me skeptically. The other half just laughed. I saw my colleagues at the table on the podium shake their heads. The point was, I did not say this in the US, but in Europe. In the US, traders had already been back on the bull train for a while the Europeans were in the midst of the so-called Euro crisis. The media in Europe was full of negative news, and you could feel it in the general mood in the audience at that conference. People were so paralyzed by the negativity that they could not see the obvious opportunities in the US. I was laughed at, and nobody wanted to talk to me after the panel discussion. Who wastes time on a charlatan and a fantasist? Honestly, that did not hurt me much. Much worse was that I did not follow my own convictions with deeds. Instead of just going long in the American stock market and building long-term positions in the biggest bull market in history and making a fortune, I went short multiple times. How can you explain this kind of behavior? How can one act against his own conviction? I have no real answer to this even today. I know that the obvious is often the hardest thing to do. We humans are apparently conditioned to prefer the more complicated path because it seems more logical or plausible to us. Simply buying stocks when they go up in order to sell them a few years later at high profits just seems too simplistic for us. But believe me, most of the wealth in the stock market was made exactly that way, by having people do the obvious. Just as it was obvious to me to short the lira when Erdogan broke his own currency, and just as it was obvious to short the Russian ruble when oil prices dropped dramatically. The obvious, however, does not have a lot of fans. As I learned at the investors' conference in Brussels, well, obviously I could not convince them. I did not even believe in my own prophecy. Otherwise, I would not have gone short, contrary to my own conviction. At that moment, one should remind the words of Jesse Livermore, who did his utmost to ignore the opinions and tips of his colleagues, so that they could not tarnish his judgment. If it was hard to accomplish this at the beginning of the century, it is almost a heroic act to keep yourself away from all of that in our completely networked times. Most people seek confirmation for their actions. Is that what I'm doing right now? Maybe there are others who see it exactly the same way as I do. Maybe we can do this together, in a group. I hope the reader can see the absurdity of this idea. Yes, it is uncomfortable to do the opposite of what a whole bunch of investors in a conference hall, who even laugh at you. But that's exactly what you should do. And do not make it unnecessarily difficult. If you have an idea or see an opportunity somewhere, then just buy a small test position. This will show you whether you are right in the market or not. And do not forget the words of the Hungarian speculator, Andrei Kostolany. It's not the news that makes the price, but the price that makes the news. If there is a crisis somewhere, then you can assume that at some point, the negative news will appear, trying to explain it all away. The same is true of the positive news, when something begins to rise dramatically. Chapter 16. How and when should you buy? Some traders will wonder how to go about progressively building a position in a market that is rising or falling dramatically. There is no right or wrong here. If you are right with your assessment, then your position cannot be big enough.
Pause it for a second so we could dialogue about what I'm seeing. Looks like definitely it's consolidating on or trying to consolidate on 8100, but everything is starting to move toward a downtrend, except for I just noticed when you flushed that. Oh, okay.
So there's nothing going on except for getting churned up in here.
I see that you flushed the charts.
The whole day has been nothing but churn. So you just gotta sit tight. You gotta sit tight. We'll wait on everything to line up. When everything lines up, we're gonna go. But I was thinking it was gonna fall apart, honestly. And it didn't. So We just sit and wait. Sit and wait. And we can continue to listen to the book. We're gonna do that 12 o'clock class here, an hour, 45 minutes. Hour.
All right.
All right.
We tend to underestimate the factor of position size when speculating, although it is more important than anything else. In my opinion, whether your hit rate is 30%, 50%, or even 70%, only plays a minor role. The question of how big your position is, if you are right, is much more important. As I said before, I do not think it's a drama to lose on your first two attempts. For example, if you lose USD 2000 twice and make USD 40,000 on your third attempt, in that case, your hit rate is a meager 33.33%, but your average profit is many times higher than your average loss. That's the deciding factor. Therefore, you should always be aware of the reaction of the market when you begin to increase your position. If the market confirms your assumption over and over again, for example, if it keeps rising on a long position, then you should continue buying. If the market does not do that by going sideways or even falling, it is clear that you should rather take a defensive wait and see stance. After all, you do not want to get a margin call from your broker. I admit that I am an aggressive buyer once the market confirms my assumption and my first contracts are in profit. I cannot stress this issue enough. With this method, it's really about learning to massively step in if you're right. The market itself is your best provider of feedback. I hope that I have clarified what this is all about with my examples in this book. Classic risk management does not apply here. You calculate your risk by first testing the water and then stepping in with a small position. Should one work with stop buy orders as soon as the market reaches a certain level? If you like to work with stop buy orders, then do it that way. The fact is that every speculation is different and each has its own dynamics. Sometimes nothing happens for weeks, and then the market shoots up in a few days, as if there's no tomorrow. In such situations, of course, you should have the courage to buy more contracts aggressively within a few hours. On the other hand, there is also the case of a market gradually rising for weeks, like a flight of stairs. Then you have all the time in the world to build up your position, bit by bit. But do not expect it to work that way every time. In general, you will have to expect both ups and downs and reversals. So depending on how many contracts you have already purchased, the fluctuations in your profit loss indicator can be significant. This is an inherent component of this strategy, and you must be able to bear it. This strategy is more of an art than a science. There is no rule that says you should buy a futures contract for every new 100 points gain. For example, if you are long in the Dow Jones future, if you feel comfortable with this approach, you should do it that way. But you should know that the Dow can easily correct by 1,000 points in one day, as of 2019. Every trader is different, and each has his own comfort zone. Mostly I assume a wait and see attitude. At the start of the movement, I tend to buy a few contracts. If the market continues to go up and confirms my assumption, I keep on buying. In the last phase, if the chart rises like a rocket, I usually buy again, aggressively. As the examples have shown, you have to be aware that the biggest gain is often made in this exaggeration phase. Therefore, there can be no static algorithm for building positions in a trend market. Every trend or exaggeration is different, and it is the trader's job to respond appropriately. I wish I could offer you a static model of how you should buy or sell if you go short. Unfortunately, I have none. Of course, if you have little or no experience with this strategy, I recommend that you take a more conservative approach first, and do not expand your position too much. But maybe that does not suit your nature. Maybe you want to go to the limit, just as I did with my
Might have
silver.
a short coming up
There's nothing wrong with that.
if it continues to go down like it looks like it's doing. I'm a little concerned about that resistance area though, but it looked like it broke through it.
I do not remember exactly how many contracts I bought at the end of that trade. Somewhere between 20 and 30, I think. You see, this is not for the faint-hearted, but neither is it for the speculators like Soros and co. And by the way, not even for an investor like Warren Buffett. Just think of his famous Coca-Cola position, where he invested a good 30% of his capital. Investors like Buffett and Soros are not cautious and do not spread their investment into many assets in order to minimize the risks. Those guys did not get rich because they were cautious and conservative. On the contrary, they became rich because they realized that you have to get in big if there's an excellent chance. And with big, I mean really big. You become rich through concentration, not through diversification. Chapter 17. Speculation is easier than day trading. It must be clear that the usual risk management methods are ineffective for this type of speculation. Since you are pushing it to the limit, I recommend that you provide a certain amount of money that you should write off from the beginning for each speculation. In other words, you have to assume that you might lose your money, either because the market you invest in is not going in the direction you were hoping for, or because your timing was bad. Of course, I tried to minimize this risk by going in with just a small test position at first. However, it could happen that an unexpected reversal puts your position out of the market, even though it had already risen considerably, and the whole thing looked good at first. That was the case with my ruble speculation, where I almost dropped out. Speculating on the stock market remains unpredictable, and a trend can turn around completely any time. That's why I recommend taking calculated risks and writing off the money from the outset. Try to see it like this. Is it bad if you lose USD 2,000 3 times in a row? That's USD 6,000 in total, and then make USD 30,000 on your fourth attempt? That would end up being an excellent result of USD 24,000 net profit. If you use this method, you have to look at it this way. This certainly does not suit risk-averse individuals, but I did not write this book for those people. I also claim that it is much easier to earn USD 24,000 with 4 targeted speculations, of which 3 go wrong, than trying to earn that kind of money by doing day trading, in which you risk USD 100 or USD 200 with every trade. That's a lot harder, believe me. I've been trying to do it for years. The method of targeted speculation with levered instruments is not only simpler, it is also much more effective, whatever day traders may tell you. Does that mean that you should not day trade anymore? And that, from now on, you should try to earn your money with a few targeted trades? No, that is not what I mean. Because there are definitely times at which you can do very well with day trading or scalping. If you enjoy it, and you are doing well, carry on doing it. I'm just pointing out that there are times when day trading and scalping do not work so well. Then you should at least have an alternative method. That may be the type of targeted speculation I'm talking about here, or maybe an automatic trading system. It does not matter. What is important is that you have an alternative when things are not going that well. Chapter 18. A separate account for each speculation. I have one more recommendation if you want to use this method. Open a new account with another broker for each new speculation. Yes, you read correctly. Open an account specifically for each speculation. So, solely for this specific speculation. Nowadays, it is no longer difficult to open an account with a broker in just an hour. So when I plan to build a position in a particular market, I choose the right broker, the broker I can best achieve my goals with. It is important to me that I have not previously traded on this account, i.e., no loss trades. Why is that important to me? Without feeling superstitious, I consider every new speculation as a kind of small business, which I open for a limited time and then close again. And most importantly, if my new
Hey guys, can y'all hear me?
withdraw.
Yeah.
So I'm looking at this and I was looking for a pullback. I was going to say something, but I didn't because it didn't give us a market structure right here. So since it didn't give us a market structure, I didn't want to call the trade. and it didn't. I mean, it didn't. So that's not part of our trade there. And I'm not saying that this won't be one, but yeah, this one right here is tough. This one right here is tough.
Well, we just wait.
Yeah, that's what we got to do. We got to wait. That's what we're doing, is just waiting on it. So you can queue it back up. We just it's nothing to do right here.
Of the entire profit, including the initial capital from the account, and close the account. Each new account is therefore intended for a specific trade, which I intend to do, and only for this trade. So I do not try to use the account for other small sideline trades. Quite the opposite. I take the money out of the speculative cycle, and I put it in a normal checking account. This way, the profit is definitely out of the risk zone. I can then do something nice with it, or invest it. For example, by buying an apartment that I can rent out, or I could make another investment, such as buying physical gold. This drastic measure will discipline you. You only have one shot, so to speak. If you fail on your first try, get out and come back another time and trade another market. Do not make the mistake that I made, of entering the same market several times. Choose something else. Because if you have burned your fingers in a certain market, you cannot see it with fresh eyes. You are, so to speak, prejudiced. I hope you can see that. One could understand this one trade per account method as a kind of guerrilla tactic. You lie in wait for a long time. You attack in optimal conditions, and then you literally get out and cover your tracks. You do not like the sound of it. Just give it a try and see how it feels. Incidentally, I hope that you have not overlooked the fact that I lie and wait for a long time. I do the opposite of what most traders who trade permanently or have positions all the time do. Sorry, I have become a pretty minimalist trader. When people ask what I'm doing, I usually say nothing. And that's usually the case. Mostly, I do not do anything. That means I do not spread my concentration too thin, with suboptimal trades that do not really advance my financial existence. You just made 3 trades, and you have USD 1,000 more in your account. Congratulations. But does this money really help you financially? Can you buy a house or make a significant investment with this money? I think that is unlikely. Why should one deal with such trades? However, if you are able to earn USD 100,000 with a single trade, then this money will really help you. For most people anyway. And that's the point. Any trade that does not take you to a new financial level is not worth considering at all. If you go the stock exchange, then it should be worth it. Old Master Castellani used to say, if it's pork, it must be oozing. And this new financial level might be different for everyone. For some, this may be USD 10,000. For somebody else, it could be USD 100,000. Or even $1 million. It does not matter. The key is that you get ahead. And to do so, optimal preparation is necessary. In other words, with this method, you will have to morph from a hyperactive trader into a keen observer. Chapter 19. With which financial instruments should I trade? You need to be aware that with a small trading account, you cannot play the full range of possible financial instruments. So do not think about imitating John Paulson, who made USD 3.7 billion in 2007 with a bet against the pompous American real estate market. He did that by buying credit default swaps, CDS. These instruments are not available to you as a retail investor. Incidentally, the whole thing about Paulson's trade was not really kosher. These instruments had been specifically developed for him, so that he could bet against the banks that had issued them for him. Of course, every retail investor can speculate with government bonds and currencies, And nobody can forbid that you short sell Ukrainian stocks if that country gets into trouble again. Depending on which investment idea is involved, I will, as already mentioned, create the account with which I can best and most cost effectively implement this idea. Of course, if you choose futures for your speculation, you need a specialized and inexpensive futures broker. Above all, you should look at the amount of the overnight margins for your idea. If they are too high, you may need too much capital to even start. Compare several brokers. You will be amazed at the differences. The cheapest are usually American futures brokers because they are often members of the CME themselves, which gives them very different terms. If futures are too expensive for you, you can try a financial construct that is basically nothing more than a derivative on futures. This refers to CFDs, or contracts for difference. You can open a CFD account with USD 1,000 or less. Unfortunately, American citizens are not allowed to open a CFD account. Therefore, US citizens should have a look at options as a cheaper alternative to futures. I think options are an excellent instrument to trade the way I am referring to here. CFD traders, in particular, should pay attention to the financial costs of these instruments and ask the broker beforehand what it would cost you to keep 10 CFDs in a given market for 3 months. Some brokers do not impose any financial costs on CFDs on futures, unlike with CFDs on stocks. This sometimes varies from broker to broker. I did my silver trade in 2007 through 2008 with CFDs. In the beginning, I started with mini contracts, but as my position grew, I was able to buy the big contract, which eventually led to the big gain. However, after 3 months, I had over 1,000 euros in financing costs with this position. Had I known that I was going to stay in this trade for so long, I would surely have chosen another, cheaper, broker. I hope you understand better now why I think it makes sense to open a separate account for each specific speculation idea. Another instrument that can be used to speculate on developments in the markets are ETFs. The big offer available in those instruments is now so confusing that you should think carefully about where you open an account. There is also the possibility of leverage, thanks to the so-called leveraged ETFs, often triple. So you can, for example, buy a triple leveraged ETF on silver. Critics of ETFs, rightly, argue the problem of so-called path dependence. This phenomenon occurs especially in sideways movements or minor corrections in a trend. As long as the market moves in the desired direction, the return is even slightly stronger than the original leverage. If it goes the other way, the ETF usually underperforms. This disadvantage has an impact on long-term exposure to a market, which is why I believe leveraged ETFs are not suitable for long-term investors. For speculators who enter the market in the medium term, 1 to 3 months, and above all, rely on a strong move in the underlying, I think it can even be an excellent instrument. Probably the easiest and most flexible tool for a retail investor are the Forex markets. Here you can even participate with very small amounts, under USD 1,000, and maybe the Forex market is also the best starting point for this strategy. However, here, one should also note the amount of the financing costs, which are better known under the term swaps. Swaps are interest rates incurred on borrowing, which is usually a Forex position. Interest rates of 5% may well occur. Therefore, when choosing a Forex broker, you should pay less attention to spreads and levels of leverage than swaps. An in-depth comparison of brokers in this regard can mean that you may save several $1,000s. This is particularly true when dealing with exotic currencies, i.e., currencies that are not part of the classic Big Seven: Euro, US dollar, Great British Pound, Swiss franc, Canadian dollar, Australian dollar, and New Zealand dollar. These are, for example, currency pairs like US dollar/ruble, US dollar/Mexican peso, or euro/Turkish lira. The swaps in these currencies can accumulate significantly if you invest in one of them for months. Chapter 20: Maximum Risk and Margin Call. If you decide to trade with professional instruments, such as futures and options. You should know that from the point of view of risk management, you are considered as a professional partner. Futures and options transactions are generally subject to an obligation to make additional contributions. If the losses from your positions exceed the margin coverage, you will receive a margin call from your broker. This means that money has to be topped up. Otherwise, the position will be closed. If you do not like the idea that, theoretically, you can lose more than you have available, you may want to refrain from trading these instruments. But when talking to brokers, this occurs relatively rarely in practice. Usually the margin calls are already threat enough to a trader to reduce the position or close it completely if necessary. Nevertheless, as a trader, you should be aware that the requirement for additional funding exists. If possible, you should never let it get that far. Several brokers I've talked to about the issue have assured me that in the rare cases in which this happened, they were always able to reach an agreement with the trader. By contrast, if you trade derivative instruments, such as CFDs or Forex, you are usually on the safe side, at least within the EU. Because of the strict regulation of the European Supervisory Authority, ESMA, which has been in force since the beginning of August 2018, the high leverage for private investors has been severely limited. Previously, leverages of 100 to 500 were common, but they are now limited to a maximum of the factor 30. Depending on the underlying value, they are even lower. With stocks, they are about 5 at most. Traders are therefore not obliged to make additional contributions, should the deposited security no longer be sufficient. The losses cannot exceed the invested capital. If you want to guard against such an event, despite this rule, you can look for a broker who offers a guaranteed stop-loss order. Here, the broker guarantees the closing of the position exactly at the desired price. The broker therefore bears the risk and must pay the costs of deviations himself. In return, the trader usually pays a fee for this guarantee. The fee can also be collected by widening the spreads. You should therefore consider this charge as a kind of insurance premium. Talk to your broker and ask him if he offers guaranteed stop-loss orders and what they cost. Chapter 21. Keep your trades to yourself. As a speculator, you'll have to be prepared to do unpopular things if you want to make some serious money, or if you want to move your account forward. And not everyone is going to like what you're doing. I would like to give you some advice as a trader friend. If possible, do not talk to anyone about your trades. Open an account with a broker and do your transactions. Do not talk about it, not even to your friends, and certainly not to your family. The reason is simple. Hardly anyone will understand what you are doing. I do not mean understanding in the moral sense, but technically speaking. For example, if you do a short sale, no one will understand it, even if you do your best to explain it to them. If you buy USD/Russian ruble, technically speaking, you are long US dollars, short Russian rubles. Try explaining that to your grandmother. If she has never done it herself, she will not understand. Look at the stock market reports on the news. They hardly ever report on what really matters. The media craves sensation, panic, or drama, or they wag their moral index finger at you. Rarely do they report facts about what is really happening. So do not be surprised when your friends, acquaintances, or family babble about what the media presents them with. And do not expect anyone to show understanding for your new occupation. That is something you will rarely get. Regarding the impact and the task of the financial markets, the general public is stupid. It is deliberately kept stupid. That might not appeal to you, but it is a fact. There are countries where trading is a little less stigmatized. This is the case, for example, in the USA. Unlike in Europe, people there are happy when you are successful. But I can assure you that this is much less the case in most other countries. Scolding the evil speculators is a simple way to blow off steam on something you do not understand. But there is a much more important reason why you should keep your trades to yourself. If you start talking about your plans, or even about ongoing positions with your fellow human beings, they will respond in some way. The best thing that could happen to you would be indifference, because that harms you least. But imagine if I had told an acquaintance that I was speculating against the ruble. Maybe even in the days when everyone could see on TV how people in Russia were queuing up outside the exchange office to get rid of their rubles. Do you think I would have made friends like that? Of course not. That could incite very moral thinking people against you. You would have to begin defending yourself, or you might even have to begin justifying yourself. And that's the last thing you should do if you're in the middle of a speculation. These conversations, or discussions with people who have no idea about the matter, will only confuse you in the end. Worse still, it could cause you to begin to doubt the one thing with which you might have financial success. Now, there are quite a few traders who solve their need for communication by visiting so-called like-minded people. Either they belong to a stock club, or they search the internet for forums or chat rooms in which they can discuss their trades to their heart's content. I admit that I did this in my beginner's years too. I started in 2001. At that time, the trading forums were something new. In fact, at the time, you were sometimes able to meet a successful trader who was willing to share his experience with you. However, I can tell you from my own experience that the vast majority of successful traders I know have long since withdrawn from these chats and stock market forums. If you really have something sensible to say on the subject, and you are constantly being attacked by some dummies, what do? Right, you take your hat and disappear forever. I do not want to rule out that there are no idealists who still visit these haunts, but sometimes the level in the pub around the corner is a haven of philosophy and human knowledge compared to what you can experience in stock market chats. I have long since said goodbye to that, over 10 years ago. I would rather recommend telling your mother-in-law about your stock market engagements than that you set foot in one of these internet chats where no one has to answer personally and almost everyone participates under a pseudonym or several pseudonyms. So do not do it. The reason is the same as your family or friends. The chance of these people clouding your unbiased view of the markets is quite large. Remember the attitude of Jesse Livermore, who even locked himself in a room so he could not hear the chatter of the other speculators. I never made money while I was in these forums. On the contrary. And that brings me to my real concern. No matter what you do in life, whether you're starting a business or starting a trading business, you'll have to do it alone. You'll have to go this goddamn way alone. And you cannot allow anyone to interfere with it in any way. Least of all, your mother-in-law, and certainly not some idiot on the internet who hides his true identity from you. I cannot stress this enough. You will only be successful when you start to become an independent trader personality. Now, everyone knows that there are only a few of them. The vast majority of people play the game safely and wander on much traveled paths. There's nothing wrong with that. If you like, I can also say it esoterically for those who believe in it. If you have chosen to push a quiet ball for this incarnation, then look for a safe government job. Find something in the administration, or how about a job at the tax office? If you want success, real success, then you will have to do something unusual. You will have to do things that those who prefer to push a quiet ball do not want, and therefore reject. I hope you now understand why it is better to keep your financial affairs to yourself. Chapter 22. On the way to the first million. $1 million is certainly a high target, especially for someone who has just over a few $1,000s available to speculate with. However, I hope that, with the examples I have shown you in this book, it will be possible to make significant profits on the stock market with small sums, no matter what some skeptics say. If I can do it, so can you. But even though duplication and multiplication in small accounts are quite feasible, they are not so easy to achieve for larger amounts. But not impossible either. As you know, you only need to double 10 times to make $1 million from 1,000. It is hopefully clear to the reader that the step from 1,000 to 2,000 is quite different than the jump from 250,000 to 500,000. Although mathematically it is the same principle. Everyone who is active on the stock market should be able to get over the loss of USD 1,000. But can you afford to lose USD 250,000? I'm well aware that there are traders who have suffered such losses, and even much more. At the end of this book, I would like to emphasize once again that you should not let it come to that with the method presented here. The idea of this method is to take calculated risks. This minimizes the risk of a total loss of the available capital. You should become a specialist in speculation, achieving the maximum with minimal effort. Precisely for that reason, I recommend that you deduct the majority of your profits from the brokerage account and withdraw them from the speculative cycle. If you ever make USD 30,000 profit with a speculation, then withdraw at least USD 20,000 from the brokerage account. For the method presented here, by no means do you need USD 30,000 to speculate. On the contrary, I recommend keeping these totals small. This measure will teach you discipline. If at first glance, this method could be classified as high risk, but this measure makes it less risky than initially suspected. The highest risk is in the beginning, when the available capital is still small. The further you progress, the less risky it will be if you consistently enter the market with just a small test position at first, and only buy more when you already have book profits. Of course, you can risk a little more if you can call the first USD 100,000 your own. But since for most speculation, usually no more than a few $1,000s margin are required, there's no reason to leave USD 50,000 in your brokerage account. Be smart and minimize your initial risk as much as you can. Maybe it will go a bit slower until you reach your first million, but you will reach your destination without undue stress. Maybe you are able to make profits of USD 100,000 a few times, or the money will trickle in gradually in USD 40,000 snacks. No matter how you do it, you should make sure that you put away most of your profits and never risk them again. This measure is just the opposite of what most traders do. They leave their profits in the brokerage account so they can trade more and more contracts. For these traders, therefore, the bigger the account gets, the more the risk increases. I try to do the opposite. The further you progress, the more capital you should always draw from your speculative cycle. Remember, trading profits are not really yours unless you have completely withdrawn them from your brokerage account, and preferably locked them away or invested them conservatively. That way, you will have the highest risk at the beginning of your career as a speculator, and not at the end. Be smart. You can always speculate, but lost investment capital never comes back. It is important to clearly understand the difference between a speculator and an investor. They have different goals, and therefore use different methods. The goal of a speculator should be to progress financially as quickly and efficiently as possible. In this book, I have tried to portray how that is done. The goal and task of an investor is a completely different one. An investor already has capital. His primary objective is to protect existing assets and to maintain purchasing power through a realistic and risk-free return. I hope you realize that these are two completely different goals. The ultimate goal of your endeavor is not to have the largest possible amount of money in your brokerage account, but financial freedom. We will look at how to achieve this in the next chapter. Chapter 23. The final goal, financial freedom. Even if the first million seems like quite a distant goal to many, it is not out of reach. The method presented here can be regarded as an important step on the way to this goal. It need not be the only one. By the way, I consider the nominal sum of $1 million more like a symbolic goal. As strange as this may seem to not wealthy readers, $1 million on the bank today is more of a problem than a solution. The times when such a sum would give you a yearly risk-free interest yield of 5 or 6% are long gone. And those countries with higher interest rates do not necessarily offer a solution either, because the compounding will be eaten up by the inflation, or alternatively, the fraudulent state will seize the capital on a flimsy justification, as happened to a friend of mine who had parked a considerable sum in a Ukrainian account. In other words, current interest rates are forcing anyone with some money to become an investor, whether they want to or not. The method presented here aims to make quick financial progress. It's undoubtedly an unorthodox method, but trust me, it's being used by more traders than you'd expect. Many a trader, who perhaps outwardly sells a particular system with strict risk management, secretly does exactly what I'm talking about here, without ever saying a word about it in public. My only goal with this book has been to present a way with which you, as a trader, can quickly achieve your financial goals. Of course, you can also do it with traditional trading methods, such as day trading or swing trading. These methods are and will remain valid, but they demand an unshakable discipline from the trader that most of us, let's be honest, do not have. That's the reason why the number of traders who fail with these strategies is so large. The method presented here assumes that most of us are not disciplined traders, but ordinary people who make mistakes every now and then. But if, as suggested here, you bet on specific events or strong stock market trends, you only need to be right a few times. But then, when you are right, you should have the courage to step in big. Many traders, like Jesse Livermore, did it this way, gradually working their way up from humble beginnings. Of course, you will not succeed with every speculation. Sometimes your position will barely earn you any money. Sometimes, maybe only a few $1,000s. Do not feel discouraged. If you stick to this idea, you will one day find the market in which you can make USD 100,000 or even more. If you skim off USD 70,000 of this money, you can buy a house or another asset. Invest this money into something you will still benefit from in 10 years' time. Preferably, buy an asset that flushes money into your pocket monthly. The latest Tesla, for example, does not fall into this category. This toy will pull money out of your pocket and will be worth less month by month. And that brings us to the important difference between an asset and a liability. An asset regularly flushes money into your pockets. A liability, on the other hand, costs you money. I owe this clear distinction to the books of Robert Kiyosaki. If you do not know them yet, I recommend you buy them now. Another way to generate monthly cash flow is to build a dividend portfolio with your earnings. This is one way to profit from your profits over decades. It's really fun if you have something like that. Believe me. You then own a cash machine that will bring you money every month without you having to do anything big for it. In other words, my recommendation is that you do not go from speculation to speculation until you finally have this million in your bank account. It may sound great to say, I am a millionaire, but this title does not mean much in times of zero interest rates. And you may be surprised when I say now, it is even not desirable to have 1 million on the bank. I want to explain this with a nice story. A friend of mine founded a company that he wanted to sell one day, and he also had enough interested buyers. He figured out he could get $4 million for his business. Many would say, great, now he can really cash in and live from the fruits of his labor. Not even close. My friend kept delaying the sale of his company. Why? I asked him when I met him again. It turned out he was really scared of the sale. Of course, there were various reasons, but one of the most important was that he felt safe as long as his business belonged to him, and he was able to pay himself a generous executive salary month after month. Because if he sold the business, he would no longer have a salary. Yes, but you could have 4 million in the bank, I countered. Sure, he answered. Only this money will bring me hardly anything. What am I going to live on? This story may seem absurd to some readers, because they believe that anyone who has that kind of money in the bank will no longer have financial problems. Unfortunately, the opposite is true. If you have 1 million or even more in the bank, then you actually have a problem. As absurd as it may seem to less wealthy individuals, this million in the bank is nothing but a pretty bourgeois dream. This dream is also the reason why so many people play the lottery. And it's also why so many lottery millionaires lose everything after a while. This million brings you hardly anything today. My friend knew that. Unfortunately, during his entrepreneurial life, he failed to invest the money he earned into assets that would have earned him a monthly cash flow. That is, a passive income. He had hardly any real estate. He had speculated a little with stocks and mostly lost. Unfortunately, the word dividend was alien to him. Rather than hoarding 1 million on the bank or even in a trading account, it's important to learn how to invest that money properly. In other words, in addition to your speculator career, you should also silently build up an investor's career. Because that's what the really wealthy have always done. They always have money, no matter what happens, because they, or their ancestors, have invested capital over and over again in assets, land, real estate, company holdings, licenses, lease income, dividends. And when the cash flow for these assets began to exceed the sum of their monthly expenses, they used that free cash to buy even more assets that brought them even more money. In the so-called old money families, this was done from generation to generation. And that's exactly how you should do it, in my opinion. You should not use your occasional stock market successes to build up an ever-growing account, with which you may splurge with your friends. No, do it right from the start. Learn to siphon off most of your profits and invest them in long-term assets. Do not wait until you have 4 million in your account, because then you might have the same problem as my entrepreneur friend, or the same problem as the lottery millionaires, who disappear after a while. Therefore, in my eyes, the goal of 1 million in the bank is a decoy. Such a sum may inspire your imagination. It is, however, better if you increase your financial IQ right from the start and learn how to invest in the long term, so that you can still benefit from this money decades after your stock market successes. It is possible, but only if you start right from the beginning. So take the most of your profits out and lock it away. With the rest, you can continue to speculate and hunt for lucrative opportunities. I wish you success. Addendum 1. Past financial crises. The history of the financial world is rich in financial crises. As I said, whatever is dangerous or ruinous to some may represent an opportunity for others. That has always been the case. If you want to become wealthy with stock market speculation, you are well advised to study past financial crises. Here is a list, which is certainly not complete. Study these crises. You will then be better equipped to recognize future ones. In addition to the crises, you will also find the possible speculations that you could have traded successfully. 1973, oil crisis, long oil, short stocks. 1973, banking crisis, United Kingdom, short British equities. 1983, bank crisis, Israel, short Israeli stocks. 1986 through 1991, Japanese bubble industry, short Nikkei, long yen. 1994 through 1995, tequila crisis, Mexico, short Mexican peso. 1997, 1998, Asian crisis, short Indonesian rupiah, Thai baht, South Korean won. 1999, Brazil crisis, short Brazilian real. 1998 through 1999, Russia crisis, short Russian ruble. 2001, Turkish crisis, short lira, short shares. 2001 through 2002, Argentina crisis, short Argentine peso. 2000, dot-com crisis, short Nasdaq. 2007 through 2008, subprime crisis, long gold silver, short stocks. 2008, Iceland crisis, short Icelandic krona. 2007 through 2008, Spanish real estate crisis, short IBEX, Spanish equities. 2010, Greek sovereign debt crisis, short AFEX, Greek equities. 2010, Spanish savings bank crisis, short Spanish stocks. 2010, Euro crisis, short euro. 2014, Russian financial crisis, short ruble. 2018, Turkish financial crisis, short lira, short Turkish stocks. As you can see, there is no shortage of crises. Almost every year, there is a fire somewhere from which you can benefit as a speculator. Incidentally, there are not many different types of crises. Here is a list of the most important types: banking crises, currency crises, speculative bubbles, sovereign debt crises, a state cannot repay its debt. Economic stagnation and recessions. If you want to deepen your knowledge of financial crises, I can recommend the following books. Barry Eichengreen, Hall of Mirrors, The Great Depression, The Great Recession, and the Uses and Misuses of History, Oxford University Press, 2016. Ray Dalio, Big Debt Crises, Bridgewater, 2018. Carmen M. Reinhart, Kenneth S. Rogoff, This Time is Different, 8 Centuries of Financial Folly, Princeton University Press, 2009. Robert Z. Aliber, Charles P. Kindleberger, Manias, Panics, and Crashes, A History of Financial Crises, Palgrave Macmillan, 2017. The End. How to Turn $5,000.
And that concludes How to Turn 5,000 into a Million, Haki Ashi Trader.
Look here, guys. Ladies and gentlemen, let me tell you something. Today has been a very interesting day, to say the least. The last couple of days have been interesting because it's been volatile, more volatile than usual. However, if we don't, let me tell you what the number one rule in trading is. Preservation of capital.
We can't really hear you. Maybe
Now.
come back to your microphone.
Can you hear me?
Yes.
Can you hear me perfectly?
Actually, I hear you louder than the first time, but yeah, we can hear you.
Okay, so the number one rule in trading is the preservation of capital. Period. And following your rules to the nth degree. Now, this is where my salt comes in, and this is why I tell people I want to listen to books during our downtime, because if you listen to the Haki Ashi Trader, I'm going to tell you that is exactly how professionals trade. When they are right, they are scaling, and they're scaling big. That's why you hear some of these crazy outlandish, somebody made a $200 million trade, a $100 million trade, a $60 million trade in one trade. Well, it's really not just one trade. They didn't get in one time at the bottom and they rolled it all the way to the top. That's really not how that works. How it works is somebody, I'm just going to use Amazon for an example. Amazon, they buy it at 170, then they buy another one at 190, then they buy another lot of contracts at 210, another lot at 240, another lot at 250, another lot at 260, and they ride it all the way up, and then they out at $500, and you're like, oh my God. So what I'm trying to get you to understand, and what I want to get you to see and believe and know, right, is how to understand how to make money. The object of the game is real simple. Make $10, lose $1. Make $10, lose $5. Hell, make $10 and lose $7. But every time you make money, you need to be making more than you lose. That way, if you have a 50% chance of winning, now you got more than a 50% chance of winning, because now you're making money. So that's it. So what we'll do is we're going to go ahead and get ready and start a class that we're going to talk about scalping. I mean, I'm sorry, I said scalping. I mean scaling. We've done one part to the scalping class. We're going to do another part to the scaling class. I gave an example, but I'm going to give now more examples and show you how you're supposed to scale into a trade. I'm going to show you how you can turn a little bit into a lot, and you can do it in an expedient fashion. This is going to be very, very informative. So get ready. What we'll do, guys, is we're going to log off of YouTube right now to end this session, because I'm not trading this crapola. You see how flat that 24,000 is? That's why I put it up on the left-hand side.
Oh, yeah.
Because it looks like that, and it's a Friday, what we don't do is go in here and try to go ham on a Friday when it's not conducive to do so. Okay, so what we're gonna do is chill for a minute, and go ahead and close out the first part of the day at 11:45, ladies and gentlemen. we will be starting the class, the scaling class. So get ready for that. We'll put the link out to you here in just a few minutes, but we're going to go ahead and log off of YouTube. And then we'll log back on here in about 10 minutes. So see you guys soon.